The biggest risk to your FIRE plan is not investing, it's withdrawing. Or rather, it's what happens to your portfolio while you're withdrawing and supposedly just letting it ride. Most people think the secret to financial independence is simple, right? Pick the right assets, set it, and forget it. But what if doing absolutely nothing is the exact thing that's slowly destroying your FIRE plan? Welcome to this explainer, where we're going to unpack the mechanics of sustaining a financial independence, retire early portfolio. We really need to dive into this because what we're about to cover might completely change how you view your passive investments.
It sounds completely backwards, doesn't it? The idea that doing absolutely nothing could actually break your plan. I mean, we're constantly told to ignore the noise, stop tinkering, and just hold on for the long haul. But over time, the real danger to your retirement isn't necessarily what you initially bought. What really matters is how your portfolio naturally drifts while you aren't looking. Quick heads up, before we get into the nuts and bolts of how this actually happens, this explainer is strictly for educational purposes only and is not financial advice. Okay, let's take a look at how this silent drift actually works.
Part 1. The Silent Portfolio Killer.
Picture this for a second. You've hit your number. You retire with a wonderfully simple, clean $1 million portfolio. You are sitting right at 60% stocks, so that's 600 grand, and 40% bonds, which is 400 grand. It's perfectly balanced, stable, and completely predictable. You've built your entire withdrawal strategy and risk tolerance around this exact split. You close your laptop, and you go enjoy your retirement.
But then, well, the market does what the market does. Let's say stocks go on a massive multi-year tear. You check your accounts after a few years, and hey, you're thrilled. Your $1 million has grown significantly. But beneath the surface of those high balances, something fundamental has actually shifted.
Because your stocks grew so much faster than your bonds, your beautifully balanced portfolio is no longer 60-40. It's naturally drifted to 75% stocks and 25% bonds. You didn't push a single button, you didn't change your strategy at all. But just by doing nothing, your hidden risk has drastically increased. You are now heavily overexposed to the stock market.
Which brings us to Part 2, Anatomy of Portfolio Drift. So, imagine the inevitable happens. The market drops. Because your portfolio drifted to 75% stocks without you adjusting it, your exposure is significantly higher. The expected hit you planned for with your original 60-40 split was totally manageable. But the actual hit you're going to take now, it's much, much larger. Suddenly, that retirement safety net feels awfully fragile. And the real kicker here? This didn't happen because your original strategy was wrong. It happened because you stopped managing it.
Part 3. The Uncomfortable Fix.
So how do we actually stop this invisible threat in its tracks? The fix is rebalancing. At its core, rebalancing simply means bringing your portfolio back to your original plan. If you drifted to 75-25, rebalancing forces that ratio back to your intended 60-40. It's basically essential, proactive maintenance. But I'll be honest, it's not quite as easy as it sounds.
The biggest hurdle to rebalancing isn't the math. It's the behavioral challenge. Rebalancing forces you to do something deeply, fundamentally uncomfortable.
Think about the paradox here. To rebalance, you literally have to sell the assets that are making you money, the ones doing really, really well, and use that cash to buy the assets that are dragging behind. Emotionally, this feels completely wrong. Our instincts scream at us to hold on to the winners and ditch the losers. But mathematically, selling high and buying low is exactly why rebalancing works. Let's look at how this plays out. When your stocks go on a bull run and grow too much, shifting your percentages, you have to actively step in. You sell a portion of those soaring stocks to lock in your profits, and you move that money into safer, stable assets like your bonds. You're effectively taking your chips off the hot table and securing them in the vault.
And the exact opposite happens during a downturn. If stocks drop hard and suddenly represent a much smaller piece of your pie, you sell some of your safe, stable bonds and shift that money back into stocks. You're buying stocks when they're essentially on sale. And to be clear, you're not doing this because you're trying to time the market, but strictly to maintain your balance.
Part 4. Finding the right balance.
Of course, knowing you need to rebalance is one thing. Actually executing it correctly is a whole different ballgame. And investors usually fall into one of two dangerous extremes. First, you have the over-tinkerers. These are the folks who react to every little market twitch, creating incredible noise and stress by rebalancing way too often. Then you have those who never rebalance. They set a plan, forget it, and basically wait until a severe market crash breaks their retirement entirely. Obviously, neither of these works.
The smarter approach lives right in the middle.
It's about making rule-based adjustments. You don't rebalance based on the news cycle or the fear you feel on a really red market day. You do it based on a simple, predetermined rule.
A fantastic rule of thumb is simply 1 or 2. You rebalance occasionally, maybe just once or twice a year. Or alternatively, you set a threshold, so you only rebalance when your portfolio drifts too far from your target, say by 5% or so. It totally removes the emotion and keeps the whole process mechanical.
Part 5. Staying in control. You know, a lot of people mistakenly believe that the goal of rebalancing is maximizing returns. It really isn't. In fact, consistently selling your winners might actually reduce your short-term gains during a massive bull market. The true goal is protecting yourself from extreme outcomes. Rebalancing keeps your risk strictly in check, and most importantly, it keeps your overall long-term plan perfectly intact.
Remember the ultimate philosophy of the FIRE movement. FIRE is not a competition to chase the absolute highest possible return at the expense of your peace of mind. It's about reaching a point of financial independence and staying there securely. Survival and stability are the real victories here.
So, let's quickly recap the core lessons we've covered today. First, portfolios absolutely do not stay balanced on their own. They naturally drift. Second, ignoring that drift increases your hidden risk without you even realizing it. And third, rebalancing is the maintenance tool that keeps you firmly in the driver's seat.
I want to leave you with this final powerful thought. Rebalancing is not about predicting the market, but managing your exposure to it. Stop worrying about what the market is going to do tomorrow and start focusing on controlling what you actually can today. Does your portfolio accurately reflect the risk you signed up for, or has drift quietly taken the wheel? Take a look at your accounts today and take your power back.